I want to discuss a very important topic right now, guys. Have you ever been in a situation where you've set up your trade setup, you make a solid plan, you spend hours and hours and hours on analyzing the charts, you've made sure you formulated the plan, then the moment is finally there and you put on the trade and the trade hovers around your entry for a while and then, just like that, suddenly stops you out. And then goes your direction, you not being in any kind of trade, and you were right on the idea. So does this happen to you often in this bear market? Are you getting stopped out again and again and again? And then once you accept the fact that you are actually wrong, price does exactly what you predicted, leaving you with no trade, well, I have good news for you, because after you have watched this video, this will help you deal with the choppy market we're dealing with. I need you to hit that like button and smash the notification bell, because in the end that is what bells and buttons are for, meant to be smashed into oblivion. First and foremost, it's important to acknowledge that a bear market is very different in its characteristics than a bull market. First, a bear market tends to range a lot more than when you are in a bull market. In a bull market, you have quick snapbacks, quick retracements, only to continue then further up. Well, in a bear market, it is much more common for price to actually make a sudden move and then die out completely, and then make another move and die off again. Therefore, you must be much more patient. Secondly, low liquidity environments. While the technical levels are still very well respected, you have to consider the fact that the majority of the people have left the market. So, first of all, if you are still here, then you are a true warrior, and much respect to you. To be honest, as a trader, in the end, it doesn't matter too much, because you can trade upwards or downwards, trading long or short. But that being said, in a low liquidity market, it can be much more difficult to scale into your positions, and it is also much harder to conceal them. Because there's a big lack of participation within the markets, the market is also prone to much more unexpected volatility as price searches for that liquidity. For this reason, it can take multiple attempts to challenge highs or lows after ranging around and about the region of interest for a while, as price likes to double check. So, how can you factor this into your trading, and how can it help you to stop getting chopped up? A. Lower your position size. Common behavior, what I see happening a lot, is that people always chase the perfect entry and therefore get into their full position size right away. I'm not a really big fan of this, because you essentially trap yourself without having much flexibility. If you build out your position more slowly, spread it over multiple entries, taking a little bit more of time, there is actually a higher chance of getting filled. But it also gives you wiggle room when it comes to your stop loss. Which leads me to the second point. Use a wider stop loss. Using a wider stop loss allows your trade to breathe and cope with choppy areas as price is testing a level multiple times as it's hovering around. This opens up the possibility to actually get an even better average entry, as you could add up on every test while not trapping yourself into your position that otherwise might have been way too tight. C. Think in percentages. Applying point A and B into your strategy might initially show you less profits due to lower positioning and wider stop losses. However, if you think in percentages, this will relieve you of the emotional side of trading. In the end, chasing money in trading usually ends in a massive losing streak. Telling someone how much money you made in trading doesn't really matter. If you made $100,000 on a trade, it might mean a lot to you, but for somebody else it actually might mean very little. Being able to talk about a return rate of, let's say, 15% or higher in a single year, money will be completely out of the equation and actually becomes relative. 15% profits, let's be honest, is a great result regardless if you did it with $1,000, $10,000 or $100,000. It shows the true potential, because in the end, if you can do it with $10,000, then why would you not be able to do the same thing with a $100,000 portfolio or much more? In the end, trading is a profession that requires adaptability. The market is always changing, and if you fail to recognize the fact that it is, then you will very likely not be a consistent performer in the markets. Let's say a strategy works well for 5 years, but it does not automatically mean it will work in the 6th year without the need for some adjustments. Avoid getting tunnel visioned and stay observant for any changes that might come to light as time progresses. Therefore, it's very important that you adapt your ways when the market conditions ask for it. If you want to know what I think about Bitcoin, then check out this video. If you enjoyed this video, please leave a like behind and subscribe to my channel. Cheers!